And all right, welcome to the Capital Mindset Show. We're going over Peri earnings, and so this will count as that video. All right, so we're going to begin the call right now.
Hello, everybody, and welcome to the Perion Network third quarter of 2022 earnings conference call. Today's conference is being recorded. Press release detailing the financial results is available on the company's website at www.perion.com. Before we begin, I'd like to read the following safe harbor statement. Today's discussion includes forward-looking statements. These statements reflect the company's current views with respect to future events. These forward-looking statements involve known and unknown risks and uncertainties and other factors, including those discussed under the heading Risk Factors and elsewhere in the company's annual report on Form 20-F, and may cause actual results, performance, or achievements to be materially different in any future results, performance, or achievements anticipated or implied by these forward-looking statements. The company does not undertake to update any forward-looking statements to reflect future events or circumstances. As in prior quarters, the results reported today will be analyzed both on a GAAP and non-GAAP basis. While mentioning EBITDA, we will be referring to adjusted EBITDA. We have provided a detailed reconciliation of non-GAAP measures to their comparable GAAP measures in our earnings release, which is available on our website and has been filed on Form 6-K. Hosting the call today are Doron Gerstel, Perion's Chief Executive Officer, and Maoz Sigron, Perion's Chief Financial Officer. I would now like to turn the call over to Doron Gerstel. Please go ahead.
Thank you very much. Good morning, good afternoon, everyone. Thanks for joining our third quarter earnings call. Together with me on the call, Maoz Sigron, our CFO. Before I'll dive into the quarter results, let's start by looking back to the last 8 quarters, taking the Rule of 40 model and applying it to our business. So Rule of 40 is used by investors to see the long-term health and sustainability of a business. It can also be used by management to make long-term prediction and decisions. In my opinion, it's the best way to assess performance through the convergent lens of revenue growth and EBITDA margin. The fact that Perion passes the hurdle of the Rule of 40 is remarkable for an edtech company and has done so in the last 8 quarters, as you can see from the slide. Perion needs to be viewed through this valuation lens, even though it's applied to a high-growth, scalable software companies, and not, in my knowledge, to our industry. Now, I want to deal with the elephant in the room. A big elephant, which can be summarized in one question, given our quarterly results. How can we keep outperforming our peers? I keep asking this question, and I think it's more relevant today than ever before. Therefore, Perion is uniquely able to react and size opportunities based on current trends that might change. But what will not change is our DNA to continue identifying trends and turn them into business opportunities. Looking at the last 8 quarters, our ability to exceed the Rule of 40 is not a series of anomalies or a one-off success. Quite the opposite. We are outperforming the industry because we are built on the fundamental recognition that edtech must be able to respond to the trends with ability and agility. Let's look at the current 4 trends that we see, and more importantly, how we're able to react to those trends. Advertisers are looking for ways to increase customer engagement, to enhance their brand equity, especially these days, moving away from standard ad units. And those that are not investing on brand equity in these difficult economic times, it's proven that they will pay the price. What we will show later on with few use cases is to what extent our high impact suite for display and CTV not just keep the customer engagement really high, but allows us to keep our margin really high. The next one, advertising shifting direct response budget from social channel to search and advertising. Our intent to action solution, known for search advertising, is doing exceptionally well and will bring some figures how this is changing in terms of advertising allocation budget. Third, advertisers recognize that consumers are voting for brands that protect their privacy. Our reaction, SORT is gaining huge momentum, and we will talk about SORT and the huge momentum that we experienced in the third quarter. Last but not least, advertisers are under growing margin pressure due to rapid rises in cost of goods. Our iHub enable us to absorb pressure and maintain our high margin. And the fact of the matter, we increased our margin this quarter. Diving into our revenue, so our revenue growth demonstrates our ability to continue shifting our business where media budgets are trending. For example, the growth of privacy trend, the growing demand for high-impact CTV, the need for retailers to transform their media business, and the fact that advertisers targeting Z generation in console game, solution that I demonstrated in our last earnings call. These are all reflected in this performance. These shifts are likely to increase, not decrease, in velocity. Therefore, ability to react becomes mandatory to continue outperforming the industry. From an EBITDA standpoint, our iHub, Intelligent Hub, is a great example of technology innovation that serve our clients and our own financial results. Balancing supply and demand yields better efficiency both for our clients and for Peri. We also benefit from operational efficiency, utilizing shared resources for all advertising solutions. We believe that the pressure on advertising inventory due to macroeconomic environment will reinforce our central control system, iHub optimizing demand and supply. Media margin increased to 41% compared to 39% in the third quarter last year. From an advertising revenue standpoint, as I point out, the trend shows the multiple ways in which advertisers are seeking to build brand recognition, make an impact while respecting privacy. The growth of video driven by our Vidazoo acquisition that happened last year demonstrate our ability to identify the right acquisition target and empower entrepreneurs to continue to grow their business. There are moments when consumer wants to lean in to a small screen, and others when they want to lean back and take it in the immersive experience of a large screen. Therefore, our ability to provide cross-synchronization is a key factor to capture attention and provide higher return on ad spend to our clients. I showed you this slide when we made the Vidazoo acquisition. The model has served us well by attracting publishers to have an end-to-end video platform that eliminates the friction of multiple vendors. As you can see, we have nearly doubled the number of new publishers using Vidazoo platform and achieve robust growth in a new spend at the same time. We believe Vidazoo will continue to grow. I want to take a moment and to dig into example which I think you will find very compelling. It demonstrates the power of two of our core competencies working together. On one hand, the high impact ad unit, and on the other hand, targeted CTV. We ran a test, and this test, we measure effectiveness of conventional standard CTV ad unit versus our high impact CTV suite, as you can see it on the screen. We did it by tracking the user that landed on client's website in both cases. As you can see, the high impact unit achieved a 400% increase in site visit and 400% higher conversion rate. Results like this are why advertisers will pay a premium for our high impact units. Premium means $32 CPM, compared to higher lower teens when it comes to standard ads. That's by itself drive another very important KPI for us, which is average deal size, which increased by 10% to $117,000. High price CPM help us maintain and grow our margin. The need for high impact will grow since advertisers are constantly looking to increase consumer attention. Okay. We're continually innovating new ways to measure the effectiveness of our high impact units. So today I'm pleased to unveil our new attention trace measurement. It's a revolutionary way to measure consumer engagement, as you can see it on the slide, with our high impact units in a real time. Let me put this technology innovation in perspective. You may know that for decades, the traditional way to measure consumer engagement with an ad unit has been eye tracking. That works by following consumer eyes as they interact with an ad unit to measure effectiveness. But our researchers and data scientists were not satisfied with the one-dimensional model of measuring attention. So working with our partner, System One, we developed a model that includes sound along with sight. We measure that through real-time analysis that literally traces attention and display it as consumer react. This will provide our advertiser with a future validation of the efficacy of our high impact units and will keep justifying our pricing model and hence our margin. We have a number of initiatives inside Peri which provide us with a pipeline of scalable revenue opportunities. One of them is our retail media solution. You probably know that many retailers are building their own media platform as a way to generate value from their first-party data, build and activate loyalty, and compete against the giant like Amazon and Walmart. The breakthrough for us is that this solution enables us to shift our transactional business to an always-on spend, which provide the predictability and sustainability we're always looking for. And the excitement of this business is that we're not waiting for the IO, we're not waiting for the campaign. This is a constant month by month spend over a course of a year. As you can see by the prestigious logos on the slide, this is being rapidly adopted by some of the America's most successful retailers. While the revenue contribution are still modest, the growth potential, given the TAM, is huge. SORT is a powerful technology for protecting privacy without storing any personal data. Our SORT business has been rapidly growing as a result of privacy trend I mentioned before. In fact, as you may know, the FTC recently requested commentary on their proposed privacy regulation, and Peri submitted a detailed perspective. I'll be happy to share with you what with our submission. Aside of our vision that the future of digital advertising must acknowledge consumer privacy, SORT function as effective flywheel that gets even more valuable and more effective as more data flows into it. No matter which metrics you looked at versus cookies, versus Google benchmark, versus ROAS, SORT comes out on top. Lastly, take a look at the quote from Mercedes. They believe privacy is so important that they want to be associated with it, and guess what? Without compromising on the result. So you're able to see the Mercedes campaign here with 58% CTR lift in SORT versus contextual, and 53% CTR lift SORT versus third party. Going back to the trend I've mentioned earlier today and our ability to react to them, having a central hub is pivotal to increase our profitability and future growth. We cannot predict what will happen on either side of the open web, demand or supply. Those are market forces, but we can be confident that by being in the center and having a two-way visibility, we can optimize the benefits for us and for our client. In its first year, HiHub contribute 40% of our year-over-year EBITDA growth, and more importantly, our ability to capture signal from all channels to a central hub, as you can see it on your screen, and analyze them is the main factor behind SORT superior performance over other conventional targeting methods. The trend where advertisers shift budgets towards direct response continues. Pay attention to what Philippe Schindler, Chief Business Officer at Google, said recently. I will read it for all of us. In challenging times like this, advertisers are carefully evaluating the effectiveness of their budget. Search advertising tend to do relatively well in such environment, given its strong measurability and focus on delivering ROI. It also well suited to quickly adjust to changes in consumer behavior. And us being a strategic partner of Microsoft Bing definitely enjoy this trend. On top of this, the latest change of Apple privacy and Facebook reduced attribution window are causing advertisers to shift budget to search advertising. We are evaluating this shift on both ends. Advertisers looking to pay more on their ads, reflecting in 42% increase in RPM. And higher intent of searchers increased their CTR ratio by 27%. With that, I will turn the call to Maoz. Maoz?
Thank you, Doron. Doron, please let me share my screen. Thank you.
Yeah, go ahead, please.
Thank you, Doron. Good afternoon and good morning to those of you joining us from the US. I am happy to be here today to present Perion's strong results for the third quarter of 2022. As you can see, Perion is performing extremely well. We are overperforming our industry in each of the financial metrics, consistently improving our results during the last 2 years, despite the global macroeconomics challenges and market volatility. The ad tech industry is not immune to the challenges. We are navigating our way between the market shift thanks to our diversification strategy, our ability to execute, our agile business model, and our innovative solutions. Giving the sense of our sustainable and predictable business model, which give us good visibility and the action we have taken to reduce costs and penetrate new fast-growing market segment, we are updating our guidance and are positive about next year. Let's look at the key financial achievements this quarter, reflecting the strength of our business model and our ability to execute our strategy. Revenue of $158.6 million, reflecting 31% year-over-year growth, the highest quarterly revenue since 2014. Adjusted EBITDA of $33 million, 21% of revenue compared with 15% last year, reflecting 87% year-over-year growth. GAAP net income of $25.6 million, 141% year-over-year growth, the highest quarterly net income since 2014. Non-GAAP diluted earnings per share of 61 cents, reflecting 53% year-over-year growth. Turning now to the quarterly result in more detail. The third quarter revenue was $158.6 million, an increase of 31% year-over-year. The strong continuous revenue growth reflects a CAGR of 38%. Display advertising revenue increased by 26% year-over-year to $86.8 million, 55% of total revenue. Market adoption of our holistic video platform solution continued to rise. Video revenue more than tripled year-over-year, representing 44% of display advertising revenue. The number of video platform publishers increased by 88% year-over-year from 34 to 64, and the revenue from retained video platform publishers increased by 67% year-over-year. Perion CTV is also gaining traction, growing by 134% year-over-year, representing 9% of total display advertising revenue. Our unique privacy-first source solution is seeing more interest from advertisers and agencies who are becoming more aware of the importance of consumer privacy. The number of sold customers rose to 140 this quarter, 11% increase quarter-over-quarter. Sold customer spending increased by 25% during that period, now representing 17% of display advertising revenue. The third quarter search advertising revenue increased by 38% year-over-year to $71.8 million, in line with the recent trend of advertisers favoring high-intent direct response advertising. The year-over-year increase in revenue was driven by a 42% increase in RPM and a 60% increase in publishers. The 16.9 million daily searches on average reflect an increase of 15% year-over-year. Let's look at the revenue mix, which reflects our strategic business diversification. The third quarter display advertising revenue accounted for 55% of the total revenue, compared with 57% in 2021, with search advertising representing 45% of revenue compared with 43% in 2021. We continue to expand into fast-growing video, CTV, and retail business, which now accounted for 57% of display advertising, compared with 28% in Q3 2021. We are benefiting from the current shift to high-intent search advertising. Our media margin continued to improve year-over-year. Revenue excluding TAC was $65 million, or 41% of revenue, compared with $47.4 million in the third quarter of 2021, or 39% of revenue. Over the last years, we have created the Intelligent Hub with several processes and automation by leveraging data and buying power in order to control and improve Perion's media buying system. This has resulted in better financial terms that translate into better selling power, which is reflected in our financial results and more specifically in the media margin. Third quarter OpEx and COGS amounted to $31.7 million, or 20% of revenue, compared with $33.1 million, or 27% of revenue last year. This impressive achievement reflects the execution of our business strategy. Perion DNA and state of mind is growing the business while keeping and improving efficiency. Over the last few years, we invested millions in technology, automation, and offshoring part of our business. We have improved budget control and are consistently looking for new initiatives for Perion efficiency. On a GAAP basis, net income was $25.6 million, or 53 cents per diluted share, an increase of 141% compared with $10.6 million, or 28 cents per diluted share in the third quarter of 2021. On a non-GAAP basis, net income was $29.9 million, or 61 cents per diluted share, an increase of 94% compared with $15.4 million, or 40 cents per diluted share in the third quarter of 2021. Adjusted EBITDA of $33 million, reflecting 94% year-over-year growth. Adjusted EBITDA margin of 21% compared with 15% last year. Adjusted EBITDA to revenue, excluding TAC, increased from 37% in the third quarter of 2021 to 51% during the third quarter of 2022. Our excellence financial performance is not limited to P&L only. Operating cash flow was $34.7 million, compared with $14.2 million in the third quarter of 2021, reflecting 145% year-over-year growth. As of September 30, 2022, we had cash equivalents, and short-term bank deposit of $390 million, compared with $322 million as of December 31st, 2021. We are continuously generating positive cash flow. The $390 million in cash will serve as a valuable resource to execute both organic and inorganic growth opportunities. This concludes my financial overview. Doron, please go ahead.
Just a second. Given our strong performance and our sustainable and predictable business model and the good visibility into the fourth quarter, we're increasing our guidance for 2022 substantially. More specific, we are calling for $630 to $640 million in revenue by the end of the year, and at least $120 million of EBITDA. That represents 72% year-over-year on the EBITDA growth, or 33% year-over-year growth on the revenue side. Another note here is that our CAGR on the revenue between 2020 to 2022 is 39%, and the CAGR on the EBITDA on these 3 years is 91%. Ending note. Let me go back to how I started this presentation. Since I became a CEO in April of 2017, my mission has been to build a company of the future for the future. That means a company that would be strategically diverse and also lightweight and fluid. I saw a future of volatility where new trends would emerge. Others would become less relevant, and where a successful company needed to shorten the reaction cycle, or it would be outrun by circumstances beyond its control. We've built a company that makes the trends its friends, and that's why we are outperforming the market and can continue to do so. In a year, those 4 trends may change, but it doesn't matter to Perion, because we will be able to react immediately to the new trends, gain market share in a high profitability while driving client satisfaction. I'd like to close this call by thanking my team, because without their ability and agility, we would not be where we are today. And together, we will continue achieving what we do next. Thanks so much. With that, let's open the line for Q&A.
Thank you. We will now be conducting the question and answer session. If you would like to ask us a question and have joined us by phone, please press star 1 on your telephone keypad. The confirmation tone will indicate your line is in the question queue. You may press star 2 to remove your question from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. If you have joined us via Zoom, please click on the raise hand icon on the bottom of your screen to be placed in the queue. Alternatively, if you have joined us by Zoom, you can also submit written questions by using the Q&A pod. One moment, please, while we poll for your questions. Our first questions come from the line of Eric Martinuzzi with Lake Street Capital Markets. Please proceed with your questions.
Yeah, congratulations on the strong quarter and the good outlook. Just curious to know, I know you released your prelim Q3 results on October 5th. What did you learn during the month of October as far as the trends in the industry different maybe than what you saw in Q3?
No, we didn't. I don't think that there are changes in October, but what we're able to see these days is that this is going to be definitely a strong holiday season, and definitely when it comes to demand for our advertiser on all channels.
Okay, and as far as your competitors go and just other players in digital marketing, there's definitely been a dramatic deceleration. You went through some of the reasons why Perion has not experienced those same decelerations, but and I know you're not giving guidance on 2023, but the organic growth that you've guided to for Q4, I believe we're in the neighborhood of high 20%. What's the sustainability of that beyond Q4?
So I must say that that was the heart of our presentation, and it's our ability to keep growing the way we did in the last 8 quarters. I think that diversification is definitely something which is important, but our ability to identify those trends and react quickly is giving us a lot of confidence on our ability to grow our business. The foundation is definitely there. The foundation from the hub perspective is giving us a huge cost leverage, and the foundation of our ability to go after new markets. I think that what we are able to achieve with those reseller is definitely evident. So retail marketing is one of this. We are investing a lot on developing new high impact formats, mainly for the CTV. We have advanced conversation with Microsoft Advertising as far as our ability to leverage our great reputation from the search part of the business into Xender and Promote IQ, the 2 acquisitions that Microsoft Advertising did. This is all part of 2023. And so we are quite optimistic. We are aware of what is going around. It makes us that we need to really work harder than how we perform in the past.
Okay, and then lastly, you talked about taking a share in social. Is that anecdotal color that you're getting? I mean, or do you have a view into, your customers are telling you, hey, we're pulling this much out of social and we're shifting it over to search, specifically on that direct response budget shift?
So there are two major events that happened on social. One has to do with iOS 14. That was kind of a year ago. And second, the fact that the attribution window in Facebook is being reduced from 28 days to 7 days. Those are mega event when it comes to advertisers that definitely view the effectiveness of social advertising and from a targeting standpoint. And we definitely see shift from social into search, because there is nothing compared to the intent of a consumer that you're able to target in search advertising. So we see a rise there. As an evidence of it, we share the RPM increase and the CTR. And this all reflected that advertisers are willing to pay more to have their ad associated with a keyword this year or this time compared to last year. The CTR shows that there are more qualified in respect to high intent consumer that will be exposed to those ads and being reflected on the CTR. So all in all, definitely a shift, and I think it was part of what we keep saying for a long time, that Perion is in a very interesting position that we are able to capitalize on those shifts that is happening. And this is the nature of this industry, because from the eyes of the chief digital officer that need to allocate its budget wisely among those 3 main pillars, they shift budget because of what's happening. And the question is how we will be victim of being a point solution that not able to do anything when there is different trends, or you're able to diverse your offering and capitalize on those trends. And I'm glad that we are on the latter than the former.
I am glad of that as well. Thanks for taking
Thank
my
you.
questions.
Thanks so much.
Thank you. Our next questions come from the line of Laura Martin with Needham & Company. Please proceed with your questions.
Hey, can you hear me okay?
Yeah, we can hear you. Hi, Laura.
Hi. So great numbers. Wow, what a performance. Congratulations. I guess my first question is, as you think about costs next year, one of the things I'm curious about is we have Twitter laying off half of their workforce and Meta today laying off 13% of their workforce. I'm wondering if that, my first question is, does that give you opportunities to pick up some excellent engineers and maybe build your costs, but really upgrade and add to your talent base because of some of these talented people getting laid off in the sort of digital ad industry?
Right on. Our HR is already all over. They're using LinkedIn and they're using any other resources because there are some great engineers there. And we have great, Israel is a small community, and I'm glad that Facebook has a huge lab here. Some of them are, unfortunately, looking for a new home. And I think that we have a huge data scientist team that is working on our iHub. And if they're hearing me now, that's definitely a good place for them. But we see it as a great opportunity. When it comes to Twitter, I must say that there is a very interesting thing that we noticed that has to do with privacy, nothing from the employment. And there is some hesitation from advertiser. It's kind of they're on the fence. They're not sure yet what is going on. And we see it immediately when they're shifting budget to other channels. So that's, I don't know how long this trend will continue, but I can tell you that advertisers acting quite quickly when they are shifting from channel or within channels. And that's something that we noticed immediately after the announcement of the Twitter Musk acquisition.
And then on interactive ad units, I'm wondering how important you feel that is as a driver to your 2023 revenue.
You're talking about the interactive ad units? Say again, Laura. I'm not. Laura?
Can you hear me or no?
Now we can hear you, but I didn't hear the question well. Can you repeat?
Oh, yeah. So I was asking about how important are interactive ad units to drive revenue in 2023?
Very good. So interactive ad unit, especially on the CTV side, is part of what we call high impact suite. And it is not the pivot of it. It's a feature. And there are some that like it, some not. I can tell you that I talked a bit about the laid back type of experience. It is really interesting to know to what extent when you are laid back, the whole performance CTV is very much under kind of a question mark that the interactive falls very well as a way to interact with your TV, make an action. I must say that at this point, the majority of our advertiser is looking at it that the viewer is more passive than we were kind of hoping. So it is there, but it's not more than, let's say, 10 to 15% of the overall CTV spend.
Very helpful. Thank you very much. Congratulations on great numbers.
Thanks.
Thank you. Our next questions come from the line of Andrew Marok with Raymond James. Please proceed with your questions.
Hi, thanks for taking my questions. So the trends on SORT look really encouraging. I guess, what does it take to get SORT more involved in more advertisers' campaigns? Is it really just an awareness issue right now? And then secondly, kind of separately, on the search market, I guess, could we drill down a little bit there, because your search business is growing well in excess of the total search market, just to get a little sense of some of the drivers there. We understand the shift towards search in a pressured macro environment, but what particularly are you guys doing well? Thank you.
Right, thank you. So first on sort. So there are two drivers, behind sort, which makes it quite important. I use the word flywheel, but we truly believe that that's a flywheel. So first and foremost, from a technology and data standpoint, more sort campaign we're doing, the better we are. That's very important figure, and I'm happy that we are able to perform well. Now, keep in mind that there are two forces here that pushing sort. One, it's coming from advertiser, that they realize that consumer preferred brand that protect their privacy. It's part of a bigger movement, which is ESG movement. And when we're dealing with a premium advertiser, that's a very important argument. However, at this point, with all the respect to privacy, they said, wow, we love what you're doing, but we don't want to compromise on performance. So all of them, with no exception, and Mercedes was one of them, that expecting us to do an A, B, C benchmark. A sort, B third party, and C contextual targeting in order to benchmark the performance on sort. The other thing which is very interesting is what's happening from a legislation standpoint. And that's a very, very interesting movement, even though it will take time. We have a feeling that this train definitely left the station. So that's what makes really sort moving. Now, to your question, we are working as we speak right now on sort as a service. In other words, currently sort is being used at Peri with no exception. And our intention is to go beyond Peri and have it as a service that we were able to work with publisher, other DSPs, and make it common use. So far, we are we just completed a very, very crucial task. Keep in mind that we need to meet a very rigid response time, which is less than 2 milliseconds on this service. So it's quite a technology challenge, but so far definitely so good. There is a great market reaction to it. So from product market fit, definitely we check this box. So all in all, we are very, very confident on our ability to provide this service even on the first half of next year. Now, when it comes to the second question that has to do with what we're doing better when it comes to search advertising. So what we are doing better very much has to do with our partner, Microsoft Advertising. So Microsoft identified that there is a time and they are putting a lot of efforts behind it. It has to do with new product that we launched during in this quarter. It's called Microsoft Trends. All in all, there is a huge effort from their side. What they realize is what's happening, with Google or with other search. So they expanding to new countries. They putting more resources on product, and that's reflected on our numbers.
Great, thank you.
You're welcome.
Thank you. Our next questions come from the line of Jeff Martin with Roth. Please proceed with your questions.
Great. Can you hear me?
Yeah. Hi, Jeff.
Great. Hi. Congrats on a wonderful quarter. Wanted to drill down a little bit more on the publisher growth within search. Up 60% year over year. You're obviously expanding into new countries. Was curious if there's things beyond that. If the high impact capabilities within search are attracting publishers. Is there anything in particular that is driving that publisher growth, and what your outlook for additional increase in publisher additions over the next 12 to 18 months looks like?
Right. So just a small correction. The high impact has to do with the display, and search is nothing to do with the high impact. high impact suite that we're doing. But to your question, when it comes to publisher, definitely with the new product that we're launching, we're looking about two parameters. The increase in spend that existing publisher is doing, and the other one, our ability to attract net new publisher. And that's going very well in both ends. The fact that we are become bigger and bigger gives us also a better rev share rate, which we are able to share with our publisher and makes us even more competitive compared to other partners. And that gives us an advantage to attract even more publishers.
Great. And then just was curious if you could give some insight into the potential to continue to grow, the average campaign size or average client spend. I think 117,000 in the quarter, and that's up nicely year over year. What are some of the factors as we head into 2023 that will enable that to continue to grow?
Absolutely. So the main factor, of course, it has to do with the units. So the whole notion of going into an high impact opposed to standard is you spend more. Yet, it's all need to be translated to a higher return on ad spend. Quite an effort to educate our customer. Don't measure us based on what you spend. Measure us based on what you gain out of this campaign, even though you pay premium. And I mentioned the $32 CPM, which is a very, very high number. So it has to do with continue with the high impact. That's one. Second, it's very important for us to come with this campaign with multiple screens. I mentioned how important it is to have in one campaign the ability to run it to multiple screens and ability to synchronize between those screens, because it's quite different on price and it's very effective because the consumer is changing screen in his way to work, at home, and you name it. So that's another factor. While we're able to have more screen in a single campaign, that's increased dramatically the spend. Now, it fits very well the agency and the brand that are looking more than ever to minimize the number of vendors. So when you're coming with holistic solution that cover all their needs on multiple screens, they are willing to give you more and more business. And it's not secret to say that getting $117,000 average deal IO, it's the same effort in getting a 90. From a sales standpoint, it's the same effort. For everything, it's the same effort because creative is being done and activation is being done, and you need to set the plumbing and you need to do reporting and you need to do everything. That's a net margin that we're able to get. So this is one of the, I think, the most important parameter that we should look at, and we're doing tremendous effort to increase the spend, but at the same time, it needs to be translated to increase value from the perception of the customer. Otherwise, it cannot be done.
Great. And then last question for me, if I could. You got a pretty sizable, cash forward at this point. Could you give us a look under the hood at what M&A might look like in 2023? Are you planning on continuing down that strategic path?
Yes. So first of all, I must say that I answered this question beginning of 2022, and honestly, I was kind of thinking that we're able to do. If I remember, I said one and maybe two even. The situation is a bit different, and I think that we all understand that we worked really hard to be in this position where we have now close to $400 million of net cash and no debt. It gives us a wonderful position. We are looking for a creative, specific target that we identify. I can tell you that we are definitely focusing on it. The intention, I now need to be more careful than last year. So the intention is definitely doing it in 2023. That's the intention. And there are some great opportunities there for us, and I'm very optimistic.
Great, thank you.
Thanks.
Thank you. Our next questions come from the line of Mark Kelly with Stifel. Please proceed with your questions.
Great, thank you very much. I wanted to ask you about, you called it a strong holiday season as your expectation for this year. And, Criteo is just one company in particular that called out a lack of an early holiday ramp in ad spend. And it sounds like maybe you're not seeing that. I guess, is the shape of the fourth quarter playing out as you would typically expect so far? That's my first question. And the second one is, and if you answered this, I apologize, but can you please give us the pro forma growth rate for 3Q with Vidazoo? Thank you.
Very good. So as far as the Q4, so far, November 9th, we're definitely, which we are almost in the mid to the quarter, we are definitely not seeing any slowdown. Plans as they were before. It may be changing mix between the different channels. Yes, that's definitely something which we couldn't, project. But as I mentioned before, the fact that we are diverse gives us a way to capitalize on these changes, and the overall looks as we planned.
Perfect, thank you. And then on the pro forma growth for 3Q, if you could give us that, that'd be great.
Yes, hi Mark. Thank you for the question. We are with pro forma above 15% for Q3. Again, this is, as mentioned during the last call, it's difficult for us to measure the exact number due to the synergy that we have between Vidazoo and the rest of the business unit, which is good. But yes, this is more or less the number. And again, as mentioned during the last call, part of the IAB benefit is definitely for Vidazoo that joined and contribute a lot to the bottom line, to the EBITDA.
All right, thank you. And 15, 1, 5, right? Just want to make sure. Okay, thanks very much.
Thank you. Our next questions come from the line of Jason Helfstein with Oppenheimer. Please proceed with your questions.
Hey, I'll ask one. So it's very clear as earnings are playing out, obviously a lot this morning, last night, that right now, like being a demand side platform is definitely a more attractive place to be because you control effectively like the buying decision as opposed to accepting the bids. In addition, being multi-platform is increasingly important. And then you're also seeing significant benefit by having supply side capabilities on the margin and controlling inventory. So far, as we've seen companies scale two-sided marketplaces, it's been incredibly difficult. I mean, talk about, kind of where you see the kind of plan from here, kind of both organically and through M&A, continuing to be a two-sided marketplace, which is clearly working in your favor. Thank you.
Yeah. So first of all, Jason, right on. I mean, that's a good description, I think, of why we're able to perform, quarter after quarter. I can tell you that from organic standpoint, there is a lot that we can grow. I mentioned few areas. On the display side, we're definitely putting a lot of efforts on retail media. I think that definitely the customer that we're talking with are very much behind on their media business, and they all want to be, where Amazon and Walmart and others are today. They have the data. That's the point. The challenge for us is to take them and from where they are today to where they need to be. And I'm very happy that we're able to do it even in an always-on fashion. It's only the start, but that's definitely an area that we are planning to invest more. That's from a vertical perspective. When it comes to the video, there is quite a very interesting thing that's happening also, that those publishers that are joining are very much putting all their video business on our platform, which give us another very interesting, what we call stickiness kind of business. And the cost of transitioning or the cost of switching is so high. And we're always looking for those kind of things that gives us more stability and more predictability on our business. So I think that there is a great way organically, to grow the business, as I mentioned in the call. In terms of the acquisition, yes, we identify, two areas where we want CTVs definitely remain high. We truly believe that there are some very, very interesting company in this domain. We're going after, those companies. Where we are today and what we wants to accomplish, this need to be a company that definitely represents, a leadership position in the domain, not less than that. It's not going to be a technology acquisition. It's definitely a business acquisition, which have, prominent first-tier agencies and customer. This is what we put, and this is the screening that we're doing at this time. And there are some interesting opportunities there. The other area, which is something that we start working and start evaluating, it has to do with digital out of home. We think that this is really interesting, especially when we are looking about conversion of digital out of home and retail. Having screens in the retail is very interesting. At least this is something that we are hearing from our retail business. So those are the two areas that at this point we're looking at. Hello? Hello?
I'm all set. You can go to the next question.
Oh, thank you. Bye, Jason. Operator?
Thank you. There are no further questions at this time, so I'll hand the call back over to you for any closing comments.
Very good. All right, guys, thank you very much for joining, and we'll see you next time. Thanks again. Bye-bye. Bye-bye. Bye-bye.
Thank you. This does end today's teleconference. You may disconnect your lines at this time. Thank you for your participation, and enjoy the rest of your day.
Thank you.
Okay, so that was the call. How did everyone feel about that? I thought, I actually liked it. I like the results. I like where the company's heading. I'm pretty happy so far. I guess I saw what some of you were commenting as the call was going on, and I was getting some work done. But yeah, no, looks like they're making good progress. Company still probably has a bit of a discount relative to the American counterparts, maybe unjustly so, but that's kind of where we're at. Anyone want to share any particular thoughts right now, either through comments or voice? And just a reminder, in case no surprises, we're recording right now.
Seems really positive. Seems like they're able to. It seems like they're confident on the Microsoft deal. At least they continue to say positive things about it without saying that it's for sure. And I know that they can't say anything until they do that. It's a lot of the thesis that they have search, which is good when you're having companies that need to reallocate or maybe cut back on some of their marketing spend. So I've been looking at a lot of the ad tech, and like Peri, there's a clear shift in terms of who's executing and who's not. You have a Pubmatic who's guiding for 1% revenue increase year over year in Q4. If you compare that to to Perion, which is really easy because they gave the full year guidance and you have 3 quarters, so you can kind of like fill the gaps in there. They have a pretty significant increase year over year. Same with the trade desk. So people are moving to higher quality. At the same time, this thing's trading at 5 times cash flow. So it's like,
The cash
it
pile they
seems,
also have. You're
well,
taking that into enterprise value?
I'm putting EV, yeah.
Okay. Oh, okay. I was like, yeah. Okay.
Yeah, no, so including that, because I think they have a 1 billion market cap, about 100 million in cash, so you're talking about a 600 million EV. I'm penciling in somewhere between 110 to 120 million in free cash flow this year. So yeah, about 5 times free cash flow for a company that's executing really well. I don't. The only thing that they have an issue with is I made a comment. The SG&A I think has to increase, which will decrease margins. I have a hard time seeing them. If you have the report, it looked like they spent a lot less in the third quarter versus third quarter last year, even though year to date it's still slightly up. So yeah, I think overall is really positive. You might see some margin compression, which I wouldn't be surprised by.
The Microsoft deal, yeah.
Yeah. So Ocean, just for reference, Microsoft is the one who's doing the advertising network for Netflix, and because of the relationship that Perion has with Microsoft's advertising department already with Bing, they have an inside into the Netflix ad market. And so they've been very positive and think that they have a very good shot. And they've said they're like, in this call, the exact quote was they're in advanced talk about that, getting into that part of working with Microsoft. So that's what I'm referring to. You could technically call it the Netflix deal, but yeah. So just, I think overall really positive. I'm actually really curious to see there's a couple other people that are about to report right now in the same space who I'm not nearly as bullish on, so I'm curious to see how they do.
Well, the Trade Desk, right? They reported recently or no? I think so.
The Trade Desk reported this morning, and about the same growth. The problem with the Trade Desk is they're just so expensive. So even at their adjusted EBITDA number, which I'm not a fan of that metric. It's why I have friends that use EBITDA. I like cash flow, but even at that metric, like Q4 this year, they're talking 230 in adjusted EBITDA. And so let's say like you annualize 75% of that, because that's pretty, or 80% we'll say. So you're talking like 800 million in their adjusted EBITDA number, and they're trading at 20 billion market cap. It's like, and I'm not even a fan of that number. It's just they're so expensive. And I think what you saw today was people kind of said, okay, yeah, like they're executing, they're a good company, but I don't think that they're worth trading at a higher valuation than a CrowdStrike, for example. I'd prefer being CrowdStrike than a Trade Desk. If they got into low 30s, high 20s, I think they'd be interesting. And they do have the optionality that they're the ones that are getting the Disney deal. Trade Desk is. So it's a great company. It's ran very well. It's just too rich, from my taste. Let me just see if any of these guys reported yet. So like Magnite's someone in a similar space. They're more CTV oriented. I think they're not very good. I'm not a fan of them, but they reported today. Let's see. Looks like nothing's coming yet. They're also an SSP, so I'm not super bullish on them. Then Viant also is reporting today. They're a DSP, so maybe they'll do a little better, but I don't like their management. And then there's like Digital Turbine. There's a bunch. anyways, real solid report, I think. Like, I don't see any reason to sell it based off this. Obviously, I don't think it's something where you go, okay, like, you know, you could. I think you're going to see some margin contraction, like I said, with maybe some gains that they had. Like, they didn't talk about this, but I meant to bring up. They pay their employees in Israeli dollars, and they get most of their contracts in U.S. dollars. So they're going to see a win from that. And then, yeah, I just think that they're probably going to increase that.
Yeah, they
Pretty
didn't
solid.
talk about that, obviously.
Oh, DSP just reported down 11%.
DSP?
Oh no, now it's saying they're up. Okay, so it's going up and down.
Viant Technologies?
Yeah.
Well, they were down 9.3% today.
Right. I just saw a tick come through that had been down 11%.
Oh, wait, whoa. What is this?
Yeah, I'm having them right now at 389.
Okay, yeah, Google hasn't updated, I guess, yet, but it's at 439 on Google. Yeah, it's not. This is the close price.
I just want to see if they released their earnings. So I think I've told you about these guys. The guys who own it. This is the company. So the name Viant may ring a bell to some of you. It's the company that bought MySpace.
No. That's crazy.
Yeah. And now they're a micro cap. I think what happened was that one like went down and went bankrupt, so now they're like Viant Inc. And let me see if they release them. I've just really like look at and they IPO'd at the right time. I'll say that. Third quarter financial results. Let's see. Oof. Revenue was 48.8 million, decrease of 4%. Gross profit. Here, I'll just put this here for you. It's not a very sunny report. Their revenue decreased 4%, even though advertisers spend. Oh, that's probably just part. Oof. Any comments? We saw the. I know there were some retail people that got into this, and I maybe laughed. They call them the Vander Crooks because their last name is Vanderhook. And they're all obviously like if you invested back at like 60, I'd be pretty upset too, I guess. Mostly myself, but. And then Magnite seemed to have good earnings. I'm just based off the reaction on the shares.
Apps Digital Turbine, they're reporting now, right?
Yeah.
Okay. Oh wow, ad tech all these ad tech firms got crushed today. The only one is Peri that I can see. Wow, that's telling.
Everyone sold everything else but Peri.
That is telling. No, that's telling. See, this is how I think. No, I'm kidding. I was gonna say that's a joke. When the market moves in my favor, I think it's right. When the market moves against me, I think it's wrong. And jokes, but also not. But also jokes.
It's not a little slight shot at a couple people.
Oh, no, I didn't even mean it like that. No. But also, I guess that's funny. No, because I didn't mean it that way, but we could interpret it that way.
Magnite's report seems pretty good. Looks like revenue ex-TAC 151 to 157 million. I wish they would compare this to prior year so I can see how much they're going per year.
Wow, my
computer's easy. Q4 earnings. Let's look at that real quick and see what they did.
My God, destruction.
Oh, yeah. So this is the one where I told you. The girl, she was on the last call, Laura Martin. She covers a lot of these like smaller ad tech players, and she thought Magnite would get either and, and I don't know why she thought this small company would get the Netflix deal or the Disney deal, and they got neither. And she's the one that like wrote this has got to be like Needham must have been the investment bank that took these guys public or something. The amount that she talks about this company. But
Jeez.
she put a report up being like, this deal with Microsoft and Netflix makes no sense. Netflix is just trying to get bought out by Microsoft. It's like, okay. You know, it's not that impressive. I'm just looking at like the year-over-year numbers for Magnite from their expectations. The last year in Q4, they're at 142 million revenue. They're looking between 151 and 157. To get at 154, that's like an 8 or 9% increase. Can you hear me, Matt? You can hear me, Fabio, right?
I can hear you. Correct. Yeah. Let me see.
Oh, you know what? Let's see. Free cash flow for the full year will exceed 105 million. And what's their market cap? They're a cheap stock, aren't they? That's probably just a metrics valuation on these guys. Yeah, so an American company trading at 7.5 times free cash flow that is growing and isn't showing that it's dying. I guess that's why they're popping on this. I wouldn't invest in these guys, but
That is strange that we have two people that can't hear anything we're saying. Everyone else can hear us, correct?
Yeah.
Okay.
oh, are they just listening to the stream and they're not in the voice chat? Like,
Oh, that can also happen, guys. Yeah, because it might be. Just go to only the voice chat.
okay, let's see what's apps doing.
Although, let me see this.
Ooh, apps. Apps is up 10% after hours.
APPS?
Yeah.
Because there's also ASPS.
Let's see what their results are. Let's see, so they're 1.6 billion valuation. What's their market cap? Their EV. Their EV is 1.5 billion. Let's check their earnings real quick. Second quarter revenue, I guess their fiscal year ending in March. Okay. Second quarter revenue 175 million. GAAP net income of 11.7 million. GAAP EPS of 11 cents. 7% decline year over year as compared to fiscal quarters. That doesn't sound great. I mean, I don't know. This is not a very, to me anyways, I mean, like maybe there's like some marginal improvement, like people thought they're just going to absolutely crap earnings, but this is not super impressive. Oh, let's go back to Yahoo.
Core audit, self-paced.
It's like fiscal second quarter had a 7% decline year over year. I guess they had a loss net last year, but they had a gain this year. But even still, like 11 cents per share of GAAP net income isn't impressive when you're a $10 stock.
All right, I'm going to end the recording for everyone watching this after the fact on YouTube. So I'll just end it here. But it was a good quarter.